Welcome everybody to another episode of Token Tank. My name is Julian Young and I'm the founder of the Blockchain Brief, and we're very excited to have you guys here today. Remember that Token Tank is a show committed to asking hard-hitting questions to promising projects so that you, our valued viewers, can make your own crypto calls. Now, for our panelists today, we have Blockchain Brad, blockchain's bluntest brainiac, Mr. K-Dub, the founder and reporter at Crypto Zombie, Jackson Zhang, the COO of Caleb & Brown, Australia's largest crypto brokerage and OTC trading desk. So today we are very fortunate to have Nevin Freeman, the CEO of Reserve, with us. Nevin, it's an absolute pleasure to have you here today.
Thanks for having me.
So let's kick things off. Would you mind giving us the elevator pitch for Reserve?
Yeah, absolutely. So, Reserve is a decentralized asset-backed stablecoin, and that falls a little bit outside of the normal categorization of stablecoins that has been written about a few times now on the internet, and so it might sound a little bit unfamiliar. And the reason why we picked decentralization coupled with asset backing is that we think that the normal approach to an asset-backed stablecoin that is centralized is inherently easy to shut down and also suffers from possible counterparty risk, especially over long periods of time. We really want to create a currency that's going to maintain its value for the far future, not just something that be an interesting product for the next few years. And then the reason why we didn't decide to go with what's known as an algorithmic stablecoin, which is when you just have tokens inside of the system that sort of self-support, is that we think that when you look closely from a monetary policy perspective, those end up not being particularly trustworthy, and we think that the exchange rate pegs on designs like that might break. So we sort of fused the two approaches and produced a decentralized asset-backed stablecoin. And there's a lot of details about how that works, but basically at its core, it involves holding a bunch of different asset-backed stablecoins in a smart contract and then having a token that is redeemable for portions of those in various different ways over the life of the protocol. And then, kind of zooming out, that's kind of looking at the technology. The reason why we're doing this is that we think that currency is broken in some parts of the world. So there's like 16 countries right now with 20% or higher inflation, according to the official numbers. And if you look at the unofficial numbers, it seems even worse. And that fundamentally is because of the fact that those governments aren't able to manage their currencies for one reason or another. And we think that cryptocurrency, like the sort of tech stack that allows you to build trustless currencies that are sort of out of the control of any individual group or person, is actually a viable way to solve that problem, to basically import currencies into those zones where humans aren't doing a very good job of managing them. And so we're quite excited about that. We also see a whole bunch of potential for stablecoins to be used for different things inside of the crypto ecosystem. And so we're looking at that too. And then,
right, Nevin, can I just jump in for a moment? Obviously, for time constraints, that was a very long list, and I really appreciate that. But, mate, I want to talk to you about your statement. You wrote an article recently saying that you have a solution that's better than the dozens of stablecoins out there. You've mentioned your asset-backed and also decentralized. Tell us, though, why you can make that claim. How can you possibly say that you've got a better solution to the already existent stablecoin solutions that are out there, particularly given there are several different approaches?
So it's a really good question. And there's kind of different ways to answer that. So for the stablecoins that already exist, they have the virtue of already existing, which is really great. A lot of these things are just ideas at this point. And so they're better than us in that they already exist and we don't exist yet. The complaint we tend to have about stablecoins that already exist, that are asset-backed, is that we think that in the long term, from a regulatory perspective, they're not going to survive. And so we're trying to build something that's going to persist through all those sort of regulatory changes over time. And then for the stablecoins that don't exist yet, the reason why we claim that we're better is that we've spent thousands and thousands of hours carefully gaming out economically how these different protocols can play out from kind of like a game theory and incentive perspective. And we've looked at, we thought of many different possible designs ourselves. And when we carefully look at a lot of the designs that have been proposed, we find we are really convinced are flaws, are ways in which you're really taking on risk and the whole thing could unravel. And we think that we have a design that doesn't suffer from those flaws that we've found. And so for your viewers who are curious, it takes too long to describe, but you can check out our blog, go to reserve.org. We've started to publish some of our analysis, and we'll be publishing a bunch of material in the coming months about our design and why we think it makes sense, and describing the technology in detail, which we haven't quite gotten to yet, but we're very hungry to do that. We'll do that very soon.
Okay. What about you, Jackson? What was your question?
Yeah, so I had a quick look at you guys, and obviously you have a very impressive lineup of investors, advisors. So do you want to go over some of those strategic partnerships and kind of more specifically on how those partnerships may assist you along the roadmap?
Yeah, absolutely. So we did sort of an advisor fundraising round with about 40 participants. And some of the big names in that round include Coinbase, Peter Thiel, Sam Altman, Digital Currency Group, Block Tower, Distributed Global, Neo Global Capital, and then several more crypto funds, and then also a bunch of individuals, people who are founders of companies, or people who own large media channels in crypto, etc. And it's hard to categorize them all, but for each different group, there was some reason why we thought really deeply collaborating with that group would be relevant. So like as one example, one of our investors, I'll give a shout out to, is called Rocket Fuel. And it's this collection of a large number of folks that have come together to invest in really interesting crypto projects. We just traveled to South Korea where some of their people are, and they took the time to put together a whole meetup for us. So they like rented the whole venue and got a bunch of people in South Korea that we never have met and never would have been able to reach, and brought them together to learn about the Reserve project. And that's the sort of thing that we're looking for from our investors. And then there's other investors who have some particular thing that they do in the crypto ecosystem that makes them relevant. So one is called GSR, and they're like a really notable liquidity provider and market maker. And obviously with the stablecoin design, there are some like market actions that need to be taken at the beginning. And so we decided to partner with them because of their deep insight and their experience and their infrastructure for doing that sort of thing.
Nevin, can I just jump in for one moment? I do apologize for interrupting, but only because of what you're saying. Now, you talked about Rocket Fuel. I want to talk to you about pooling. I want to also talk to you about this kind of service-led conversations that you've had. Did you definitely have conversations with each of your investors about listening to how they can offer services beyond just the money? And I also want to find out about pooling. As you mentioned, Rocket Fuel, how do you ensure that pooling doesn't go on with some of these strategic investors that you have spoken to, even though you are trying to be more community-led and community-driven?
So I want to make sure I understand the word you're using. Are you saying pooling?
Pooling, yes, because you mentioned Rocket Fuel, for example. Now, there are public entities out there who are all trying to collectively get together and try to be more in the spirit of decentralized support for projects like yours. Mm-hmm. But the inherent risk is also pooling, whereby there's advantages, fees sent out. There's always that happening in crypto. So how do you ensure, what kind of vetting are you doing, and what kind of mechanisms are in place from the top down to make sure that the way in which you take on board these strategic investors is secure and is legitimate?
Yeah, so if I understand your question, I want to make sure I do. You're talking about if someone sort of represents that they're investing, but then actually they're shopping out the deal to many others?
Exactly.
Yeah, so we forced all of our investors to go through a really strict KYC process where they had to specifically report where the funds came from. And we chose to do this because we did a Reg D 506C offering. Even though we didn't publicly advertise on the internet, we sort of wanted to take the conservative approach and use the safe harbor. And so that meant that, I thought about that pooling issue, and sort of by virtue of the legal constraints we were under, we had to do a KYC process that kind of made it hard for someone to do that in the first place. So to my knowledge, that didn't happen at all.
So Nevin, I'm gonna flip this back to Reserve, because I want to learn about you guys, and I want to learn about the project here. So tell me a little bit about your guys' background, and then why did you decide to tackle this problem, right? And in particular, too, I would love to have you address, why do we need a stablecoin for those who don't really know what that is?
Yeah. So I personally got excited about Bitcoin in 2011. That's when I first encountered the white paper, and I I was excited about it because it's a way of implementing money that doesn't depend on the existence of functional governments. So I wasn't personally concerned about the privacy aspects of it. You can have governments sort of crumble and fail, and the monetary system survives because it's just held in place by positive economic incentives. And so I thought, wow, this could be like the new currency for the world because this is something that could persist in a lot of tumultuous times. Maybe it'll take a while, but it seems like it could happen. Within about a year, I lost my faith in Bitcoin because sort of thinking it through, I ended up concluding that the monetary policy of just slowly growing the supply and then capping the supply would lead to a lot of volatility, and then even in the limit, perhaps a deflationary currency, if not a volatile one. And I thought that neither of those were really viable options for a currency. So I concluded, no, this isn't going to work. It's not going to be adopted as a currency. I went out of crypto. I did a bunch of other stuff. I built a couple of companies, a news website for financial advisors, did a medical research company, and then spent several years building a company builder here in Oakland, California, which is like this group that gathers entrepreneurs together and periodically spins off companies. And then a little over a year ago, 14 months ago now, I returned to this question of, I was sort of hit by the fact that no one had created a cryptocurrency that looked like it could really be used as money. There was a lot of energy, obviously, in the industry last year, and so I thought maybe now would be the time to do that. Got some of my collaborators together, and we were really excited. We came up with a way to do it. Initially built a team of 10 out of that company builder, and have grown to a team of about 20 since then. And the reason why, for reviewers of like why a stablecoin, so like I said at the beginning, we just think that there are a bunch of parts of the world where like we take for granted that currency is stable. Like you have some money now, it's going to be worth about the same amount next year, about the same amount a couple of years from now. There are parts of the world where that's really not true. It's like you have to pay like a 40% tax on all of your money every year, not just your income, all of your money. And actually, there's a slide on the talk that I like to give now where I can talk about like the numbers, the amount of inflation, and then actually if you look at the degree to which cryptocurrencies in the past several months have lost their value, it's actually pretty similar. So imagine if your crypto holdings were your savings, were all of the money you had, and that was just the money you had to deal with, and it was just losing its value that fast. That's happening now in the world in several countries, right? And so there's this super, super important real world application where like we can just trade out of those cryptocurrencies into something stable. They can't. So it's just people who are suffering in the way that people with their crypto holdings are, but just for real with their real money all the time. So we think that this is this amazing opportunity to create something that doesn't change in price, at least relative to the US dollar, and then hand it to those people so that they can save money and spend in a way that makes sense. And then, like I said, there's a bunch of things outside of that, but that's the big application that kind of drew us into this project.
But Nevin, with respect, I mean, you're mentioning that you are pro-currency, but essentially, as the name reserve implies, you want to be a treasury, isn't that right? You don't really want to necessarily be a startup per se, but you want to support startups by being the bank.
So that's a really interesting point. So a lot of stablecoins talk about means of exchange as the application. It's like, let's turn crypto into means of exchange. And we do want that. But we actually think that the initial application, at least in this developing world scenario, is store of value. And we chose the name reserve in part because we do want people to think of this as a stable store of value first. And part of that is because this is a little bit technical, but the network effect on a means of exchange is really, really intense. A currency for spending is only useful if everyone wants to accept it and everyone else is already using it. But with a store of value, all you care about is it going to store my value? Like, is it going to retain the value or grow in value, and can I convert it out into something else later? And so that means that it's much easier as an individual, as an early adopter, to adopt a new store of value than it is to adopt a new means of exchange. And so the name reserve and the way that we're sort of going about presenting this is consistent with the fact that we really want to kind of first offer the store of value and then transition into being a means of exchange over time.
Right.
I love that analogy, by the way. I'm going to
likewise. And I want to really bring out the controversy, because one of the things I know I often do is get too serious. But I think that in this respect, it's worth broaching. The BTC itself, as the first iteration based on the Nakamoto protocol, it was all about two things. It was about security. It was about providing for a really probabilistic solution. But also, it was that SOV. You're anti-BTC from what you said based on its volatility alone. So what's your position in that respect? Let's talk about that. BTC versus you with regard to SOV.
Yeah, so I do have a controversial view here. I think that Bitcoin, a lot of people like to talk about how Bitcoin seems like it could replace gold. And I don't think that that's impossible. I think that could happen. But when I try to think about this, as someone who might buy it in order to make money, gold has this enormous history of sort of being embedded in the culture. And it sort of came to be embedded in a time where there wasn't all that much competition. You couldn't just create sort of infinite copies and market them differently and distribute them differently and so on, because it was this physical element. And there were a few other metals that were similar, and actually some of them got used as a store of value, like silver and so on. But it's still this very low competition environment. With Bitcoin, it's a very, very high competition environment. And it's clearly dominant right now, but I just don't see any good reason to be confident that it's the particular shelling point for the long term as a store of value crypto asset. And part of the reason why goes back to what I just said, which is that with the store of value, the network effect is not particularly strong. As soon as everyone starts to believe that Bitcoin is going down, everyone starts switching out of it. And if they think that something else is going to replace it, then they'll just switch to that something else. And so the way I see it, actually the sort of secondary tokens that are attached to these means of exchange stablecoins. So actually, brief caveat on that, a lot of stablecoins have a design where there's the token that doesn't change in price that's meant to be stable, and then there's some other token in the system that is meant to be volatile and is meant to grow if the system gets adopted. And they're sort of inextricably linked, such that if the stablecoin gets popular, then that secondary token is more likely to grow in value. Not 100% likely, make sure that you don't buy things without understanding them, et cetera. But those secondary tokens that are attached to stablecoins, I think, have a better chance of being entrenched as a long-term store of value, because they're attached to this token that can get the extremely strong network effect of being used as a true currency, as a means of exchange. And so that's something that's much, much harder for people to switch away from once it becomes popular. And so my casual prediction, not really knowing for sure, is that something like reserve shares or some other secondary token in a stablecoin system has a better shot at being entrenched as the long-term crypto asset store of value than something like Bitcoin that can have lots of competition. It's very easy for people to switch away from it.
On that note, Nevin, so what is your metric of success here? Is it for that secondary token to increase in value, or is it for the market cap of the stablecoin, the amount of money in the system to be, large, or is it the number of people using your currency from, the emerging markets?
Yeah, that's a really good question. I guess we value all of those. When we're thinking about our metric for success, I tend to focus more on sort of how do I put this? So it's not just the market cap of the stablecoin, it's more like the real demand for the stablecoin. So we could end up in a scenario where there's a bunch of kind of synthetic demand for the stablecoin, where people are using it temporarily for some application inside of the crypto space, but that's likely to be ephemeral. I'm sort of at the end of the day focused on how much of the world can we transition over to using this crypto asset as their currency? And one thing to mention there is that in the long term, the way our design works, it actually will be able to go off of the peg to the US dollar. So it'll end up being an independently stable cryptocurrency is the vision. And so if we can build a huge network and then we can actually successfully make that transition, that's actually a world where we're not dependent on governments to manage the money supply or to manage the value of the money, which is, I think, would be really cool.
Right. So step one, you'll focus more on that security aspect, the investment aspect, because that's what an SOV stands for. And then from what you're saying is you're moving more into being a proponent for the robustness of utility, because obviously you want to endorse the utility tokens of the ecosystem and become that utility. But you still haven't clarified for us, I don't think, exactly how you're going to be that utility token as well. Can you talk us more about that with regard to what the stablecoin can do in that space of utility rather than SOV?
Yeah. So inside of the crypto world, there are a bunch of straightforward applications of stablecoins, and then I think there are going to be some surprise applications that nobody sees yet, that I don't see yet. So the straightforward ones are obviously, Tether is by far the most successful stablecoin right now. It's used by people in the crypto space mostly as a means of exchange to sort of trade out of one coin and move money to another exchange and trade it into another coin. And so we can offer that service as well. But beyond that, it's also the case that crowdfunding, we think, can be done more responsibly in the crypto world if it's done with the stablecoin. And the reason for that is that if investors contribute a stablecoin, then that can be locked up in a smart contract and only released to the project over time if the investors vote to release those funds. And the project will be willing to do that, we think, because the value of that stablecoin isn't going to fluctuate so much. You wouldn't want to do that structure with Ether. And so smart contracts provide this really cool use case of a sort of decentralized escrow, but no one really wants to do that with volatile currencies. And so we think that this could be better for the most legitimate projects because they'd be able to raise more money. We think they would want it because investors would be more willing to contribute capital because they're taking less risk because they know that they'll get it back if the project doesn't work. And then for projects that raise this way and end up falling apart, then that money doesn't get wasted. It ends up, being returned to the investors. So that's something that we're excited to see happen. And then also, lots of distributed app developers have been coming to us and saying, we would like to integrate a stablecoin directly as a means of payment in our distributed app. This makes a lot of sense. It's much more convenient to pay in a currency that's stable than in all these disparate currencies that are all fluctuating up and down. And then even if there are a lot of distributed apps that have currencies that fluctuate up and down, we think that if those get popular, users might not want to hold those fluctuating currencies. They might want to go buy that token and interact with that app and then trade out of that token into something more stable in between usage of apps. And so those are some of the straightforward applications. And like I said, I think there's also like a lot of creative things that could happen once you actually have something that feels like money that can be used in smart contracts, especially if it's something that people trust to hold for long periods of time, because then they'll be willing to engage in applications that involve locking it up in a smart contract and having it paid out to this person under that condition or what have you. So those are some of the crypto applications. Yeah, and then in these developing world scenarios, so I think that, like I said, I think it starts off with people essentially having a stable savings account on their phone. Phone penetration is really high in a lot of these places. But then eventually, if you've been buying and selling this currency from like your local grocer, eventually it's like, okay, we both have the currency. Why am I trading out into this other currency to buy something? We can start just doing those transactions directly. We want to facilitate that means of exchange. And then, yeah, I'll leave it at that.
Thanks.
Love that answer. Really, really love that answer. Kyle, do you want to jump in here, or do you want me to squeeze in another question?
You can go ahead.
Okay, awesome. All right, so Nevin, can you walk me through what the different current stablecoin stabilization mechanisms are? So, promissory note, credit design, secured shares design. Be brief on those, and then I want you to compare that to how you guys are doing it.
Okay. Yeah. So I'm going to use a slightly different breakdown. So we've come up with a way of thinking about this where you kind of look at the way that the collateral in the system works and you categorize it, and that helps you think about it. So the first category is centralized external collateral, where centralized means it's managed by a central party, and external means that the collateral is some asset class that sort of isn't part of the stablecoin system. It's not a token that you're creating anew. It's some external thing that already existed. So like Tether and TrueUSD are examples of this, where you have dollars held in bank accounts, and they're managed by a central party in order to back the stablecoin. Most people understand that. Then there's the category of decentralized internal collateral. So decentralized meaning that the collateral is tokens that are implemented on top of some mining network, and internal meaning that it's a newly created token that's internal to that system. It's not an external asset that already had value somewhere else. And so the senior shares design, for people who are familiar with this, is an example of this, where you have the coin and you have the share. So the coin is the stable coin, and the share is a secondary token in the system that's created anew with the system. And then anytime the price of the coin goes below its pegged price, let's say the pegged price is $1, that's what most of these systems use. Let's say it's down to 95 cents. The system will mint, new shares, new share tokens, and offer them up in an auction to the market for coins. And so it's increasing the number of shares in circulation and decreasing the number of coins in circulation. And the idea is that you're taking the coins off the market, and that's bringing the coin market price back up. And that's the basic way that the exchange rate peg works in the senior share system. And there are some other designs. So there's some other designs that are kind of derivative of senior shares that work different ways. They have maybe 3 tokens, or they have a token that gets its value because it's backed by fees in the system later, what have you. But they all end up having the same fundamental issue from our perspective. So let me talk about like the issue with those two, and then how ours works and how we think it solves that. The issue with the centralized one, people are pretty familiar with this, is just that they can be shut down. And also, we think that over the course of 100 years, you might not be able to trust that institution to always make good on its promises. Maybe the people at some centralized stablecoin are really honest and trustworthy now, but over the course of time, that institution breaks down, and then someone ends up running away with the assets.
Well, my question, not to cut you off real quick, but I mean, how centralized are you guys? You know what I mean? Like, how do we know that the same thing can't happen to you? I mean, the Gemini token is an ERC20. They can basically freeze it whenever the hell they want. There's new stable coins coming out every single day. How can you be so confident, and how can we know that we can trust what you're really doing?
It's a great question. Really good question. So let me just say one more thing, and then I'll get to that. So that's the issue with the centralized version. We see the issue with the decentralized internal collateral version is basically that those secondary tokens only have value if the system continues to exist, and in some cases continues to grow. And so if you look closely, you often find ways in which confidence can spiral downward and the whole thing can fall apart. And a lot of people could lose a lot of money. And again, check out our blog if you want sort of more detailed analysis of those. The way that our system works is to hold a bunch of tokens that are, in some cases, pure crypto assets, like Ether, things that are totally decentralized, and in some cases are tokenized real-world assets, like TrueUSD is a project we like, probably will hold some of those tokens in the smart contract. And then basically, by doing that, so the vision is that over the course of time, the smart contract that we call the vault that holds this portfolio of other tokens will have hundreds of different tokens in it, including many real-world assets that have individually been tokenized. So each one of those still has that risk, has the counterparty risk, has the risk of government intervention. But if you have tokens that have been issued by many different issuers all over the world in different legal jurisdictions, then you can actually make it so that the risk that all of those get shut down all at once is very, very low. So then you end up having a sort of much safer and more hedged portfolio. What this means is that our protocol itself is totally decentralized. It's just a set of smart contracts. We, in the limit, don't end up having any control over it. And the tokens in our system are just totally decentralized. And then these tokens that are held by our smart contract, in some cases, are fully decentralized. In other cases, have that centralization component. But you can sort of decentralize the issuance itself by holding many of those asset-backed tokens. And so the issue is that you can't do that today because there aren't enough of them. There are only a few right now. And even over the next couple of years, there will still only be a few more. And so you can't really get any meaningful level of diversification. And with the totally decentralized crypto tokens, obviously they all go up and down at the same time, so you really can't diversify at all. And so the way that our system solves this is we start off with substantial over-collateralization. So the exact percentage, let's just say, read our future papers to see what percentages we settle on exactly, but it's like between 200 and 500%. So let's say, for the sake of conversation, we have 300% collateralization. That makes it so that you can hold this basket of other tokens, and even if the value fluctuates quite a lot, you still have more capital than you need to back the stablecoin. And so that's how we can bootstrap this network, even when you can't get that diversification. And then over the course of time, we approach a scenario where you have one-to-one collateralization with a much, much more diverse set of tokens that are held in that smart contract.
Nevin, can I just jump in for a moment, though?
Yeah.
I think what we want to try and understand better, though, is your nature with regard to your structure, your core structure being whether it's centralized by default. And I say that because you have things built in like the vault. And when you have something like that, that implies inherently that you have degrees of centralization in the overall structure. So it might be one thing to have the smart contracts built in and they're decentralized, obviously. You mentioned that building upon that, you want to build out a very diversified portfolio. But that doesn't mean necessarily that you are purely decentralized because of those things. So talk us through any risks of centralized control from a governance position. What's the model? Who's going to be controlling this? Is there some sort of corporate body?
That's a good question. So just to note for the viewers to make sure that they understand, the vault itself is just a smart contract. So the vault isn't an actual vault or even something that our company manages. It's just a smart contract that is on the Ethereum blockchain along with the other smart contracts that implement the protocol. And the governance of that smart contract and the others ends up in the hands of the token holders. So it ends up being that both the reserve share tokens and the reserve tokens have some voting power over the course of time. And it's important, it turns out, to give voting power to both classes of token holders, not just one, because if you think it through, their incentives don't always perfectly align. And so if you give all the power to one, they might take actions that are sort of counterproductive from the perspective of the other. And so the particular voting mechanisms are like a bit nuanced, but for people who are familiar with Tezos, we like their voting structure, and it's like kind of pattern off of that. It's a similar approach.
Right, but first off, who is going to have control? Because often when we talk to other projects, and we talk to a lot, they have this very chronological process to unravel the decentralization. Mm-hmm. So what's happening first? Are you going to have degrees and nuances of centralized control?
Yeah. So well, let's see. So what can I say that's useful here? Basically, the way that we have approached this is to try to set it up so that if there is any sort of emergency scenario where our developers, by virtue of understanding the code the best, are in the best position to fix some problem that has occurred, we want the governance process to not get in the way of that. But then given that sort of goal, we want it to be sort of as decentralized as possible from day one. And so I'm going to give an example of how I think this is going to work, but I want to make sure that I make it clear to everyone watching that they should review the documentation and the code at the time of launch in case we decide to make some nuanced change to this. The way that we're thinking about this, for example, is that we can have a setup where we can propose changes to the code, and at the beginning, the modification to how the governance works is that the token holders can either vote it in or vote it out, and if they don't vote it out for some period of time, for example, 30 days, then it gets implemented. And that way, even if there's low voter participation at the beginning, which is something that we've seen in many blockchain projects, that doesn't stop the ability of the core developers to make changes in the cases that it's necessary.
Nevin, are you worried that you're maybe overcomplicating the process of a stablecoin? Like, if you're going to have all these smart contracts and have it be decentralized, where you're saying that you can't touch it and it's just kind of out there, doesn't that leave a lot of potential loopholes with all these different balancing between the vault and the shares and the reserve? I mean, it just, to me, it seems really overly complicated for what it is. And I understand the logic of, okay, well, in the US, why not just hold $1, right? I get it. In other places, they don't have access to it. Yeah. I just wonder down the road, is this going to, if there's a black swan event, for example, are you prepared for that? What do you have in reserve for that?
Yeah. So we have thought a lot about different ways of doing this, and we tried as hard as we could to keep things simple, in part because simpler things are less likely to break, and in part because we really want people to understand how this works. And sort of as you see through this conversation, it's quite complicated. And that's a downside, I think, to how this is being built.
Well, if you're trying to gain people's trust and they don't understand what they're using, exactly, they're not going to use it. So
and so we sort of only added additional complexity over the course of the development process when we were absolutely forced to, when we couldn't think of a way to do it that was simpler, that still had the properties of robustness that we cared about. And so our sort of sad conclusion at this point is that this is kind of the simplest way that you can build something that actually has the sort of full robustness for what we're going for.
And the thing is, I wanted to ask you as well with regard to pegging. You mentioned that, and it aligns with what KW is asking with regard to the inherent risks of your asset-backed approach, is that pegging itself by default, aligns with centralized interests. With USD, for example, your article, you even mentioned things like there's often a tendency to have a centralized currency board when you see pegging emerge. So how are you going to move away from that anomaly of pegging, centralization, USD?
Yep, great question. So a lot of stablecoin designs sort of peg to a currency, and then they have the idea that maybe they can get off that peg by directly measuring the purchasing power of the currency and using that information to adjust supply, so that you're actually just stabilizing in real terms. We find that appealing, but we couldn't think of a way to do that we were convinced would work. That sort of felt like a pie in the sky approach to us. And we hope that people figure it out. But we decided not to rely on that. And so that's part of why we have this vault-backed approach. And the idea is that in the long term, that portfolio that's held by the vault, once it's sufficiently diversified, will become itself relatively stable in real terms, like completely separate from the US dollar. And once that state is reached, we think that at that point, the protocol can stop even referring to the US dollar price of the reserve token and just have it be the reserve token essentially represents a fractional ownership of that index. And so then it's kind of like all these different financial assets and commodities and so on all around the world aggregated together into this, carefully structured and like relatively stable index. And then you just have this single token that has all the properties of cryptocurrency that can be sent around the world instantly and for free. I mean, roughly instantly and for free. And so it can actually be used as a currency, but it's just backed by that sort of real economic value in the world and totally out of the control of any humans or governments. And so it's, in a sense, it's kind of hearkening back to commodity money, but the sort of modern sort of technological decentralized approach to implementing that.
So to put it crudely, do you want to be the
Hey, Brad, we're running short on time here, so I just want to actually have Jackson ask one of the last questions, and then Jackson, this is absolutely fascinating. I feel like we could talk about for hours. We will absolutely take you up on individual interviews, I think, to kind of dive into more of the core. But Jackson, why don't you take the last one before we actually sign out of here?
Yeah, I actually I want to get your insight on exchanges. So as the ecosystem grows, I see every exchange is going to adopt some kind of stable coin as that source of fiat liquidity. Now, it doesn't really make any sense for an exchange to not support multiple stable coins. But do you see a scenario where we start seeing exchanges accept multiple stable coins or stable coin swaps for credit on their platform, and how that may kind of affect the market, and how you guys will try to take more of the market share in scenarios like that?
That's a good question. So I think that exchanges are in a state of pondering right now, thinking about what to do, because there are so many stable coins in development and so many that are actually being released, and it's sort of unclear what to do about that. From what information I have, I think that there's a concern that if you add too many stablecoins as sort of base trading pairs, then you might divide the liquidity on exchanges too many ways and cause a worse user experience than having a small number of stablecoins as those base trading pairs, kind of like we do today with Tether and then also Bitcoin and Ether. So I think what's going on is right now exchanges are thinking about sort of whether there's any reason to switch away from the current paradigm that's based on Tether, and then if so, which small number of tokens make sense to switch to. Because I think that they're concerned that if there are too many, that could actually make their customer experience worse, and they care a lot about their customers, of course.
Fantastic. Well, Nevin, I know that we just scratched the surface and there's so much more digging that we would need to do, but I just wanted to thank you so much again for taking the time to be on Token Tank. So with that being said, ladies and gentlemen, this wraps up this episode of Token Tank with Reserve. Thank you again for joining us, Nevin. Now, audience, it is up to you now to provide your feedback on what you think about the Reserve project. Please be sure to leave your comments below, and don't forget to tune into the next episode of Token Tank.